Welcome, everyone. Good morning and good afternoon. It's a pleasure to have you here, and I want to welcome you to another exciting panel of the INADBA Digital Blockchain Week. This panel is very packed, and it's focusing on what are venture capital companies looking for in the blockchain industry and how they see or foresee the future. So without any further ado, I would like to welcome moderator of the panel, Jean-Christophe Matronet from the company Fienpop. He's the co-chair of the finance working group at INADBA, and I would like to give the floor to him to start the discussion. JC, the floor is yours.
Thank you, Bara. You just saved me 2 seconds, so that's great. You do the part of the introduction for me. So basically, in this panel, we're gonna take a look at 2 dimensions. Is what is the perception of the investment community on blockchain projects? And the second dimension is whether the investment community believes that the blockchain technology can be of any use for themselves. And to do that, we invested panelists that cover a range of investor or actors into the investment community. So I'll quickly run through the introduction because we have a lot of questions to go through. The first person is Marguerite de Tavernos. She leads Ledger Cathay Fund, which I understand is a fund that focuses on seeds and Series A investment. Peter Sima is the founder and partner of Depot Venture, which is a business angel fund. He's a board member also of the Business Angel Network. Frank Devigne is the founding partner of, and Frank, sorry if I pronounce this wrong, but True Global Venture Fund. It's a lot of letters, which invests in unicorn investments and is Singapore registered. Dominic Briggs joins us from Blockwall Capital. He's a founder of this fund and he is acting as venture capitalist. And finally, from the United States, and thank you for waking up that early, we have Vanessa Grellet. She's a managing partner at Agley Venture, and they invest in different stages of companies. So the way we're gonna go through the panel is we have prepared a few questions for which each panelist will give his point of view. And then we'll open up the floor to questions if there are any. And the first question that I have to ask you guys is, as an investor, what kind of ask do you have when you review a blockchain-based project?
So first of all, I think it's just because it carries the theme blockchain, it doesn't really make a huge difference in comparison to traditional venture capital. So we, for ourselves, for example, we invest in pre-seed and seed. Just for the audience who are maybe not so familiar. So pre-seed are companies age 0 to 1, idea, MVP stage, first POC trials, very founder-driven, but more qualitative KPIs. And seed is more 1 to 3 years MVP in place, but no pricing model yet, trying to figure out how to go to market. So these are very qualitative KPIs. So in that sense, why do we really need blockchain? Is it a crucial component? Is it really better than using a Web 2-based solution? Or maybe blockchain is only part of the roadmap in the future. And so we have one fund only dedicated to equity, so no token models. And we have 2 funds focused on token models. So there we really want to see why do you need a token, and most of the time we see a lot of deals where tokens are not necessary, and why the market timing is now. And especially in this early stage, we look a lot at the team profile, showing relevant experiences and knowledge about the market, prior successes, understanding the long-term vision. And what we see more and more at the moment, and this is where most of the discussion with founders in an initial due diligence go about, is do they understand what venture financing is about, right? Have they thought about their strategy of fundraising, legal structure, cap table, their runway, and how their dilution will affect them along the way, and how they will go to market? And there, especially And this is for any founder who wants to dive deeper into this. Maybe have a listen to Mike Maples from Floodgate on hack value before hacking growth. That is extremely important, that founders don't raise cash just because they can, but really only for what they need. And for pre-seed seed, it's not about building a sales team yet. It's about understanding what value proposition there is for the customer and how to earn revenues in a short time frame. And we see a lot of startups which have a too high burn in the beginning, which build up sales teams, which is not necessary in the beginning. So really be lean, be hawkish on burn. And these are all facts which are not really relevant within blockchain, but for ventures in general.
Okay. Marguerite, what do you think of that?
Yeah, I mean, to second what Dominic says, I think there's a lot about firstly, there are a lot of specificities that are specific to early stage and not to the blockchain industry specifically. On that, I think team is by far the most important factor. And obviously, it's kind of like something that you can't really control, but it's by far what is going to be much more important in the balance when we make the decision to invest at early stage. It's less so at a later stage because you can have changes in the management team and you have the numbers as well that are going to be speaking for themselves. But initially, it's a team bet. And so we're going to look at how the founders complement themselves. And obviously, in the blockchain industry, you have a specific focus as well on the technical sets of one of the co-founders or of the founding team as a whole. And then the market is also very important. And again, to support what Dominic just said, the go-to-market strategy is really what needs to be achieved between the pre-seed through to the Series A phase. And understanding whether or not your proposition is too early or too late for the market that you're targeting. For the blockchain ecosystem specifically, timing is incredibly important. So as an investor, we would be more or less bullish on specific spaces because we will think that some spaces are mature enough to offer kind of like immediate opportunities. And we see other spaces that are incredibly interesting and we want to stay close to them and understand how those kind of subsectors are evolving, but where we don't necessarily see an immediate opportunity because we think that the adoption is not there yet. And in crypto, I think, there are two underlying factors that we focus on. It's the technology and the maturity of the market for the adoption. And therefore, those are kind of aspects that we would focus on, I would say.
Peter?
We are not a crypto investor, I must say. We are startup investors, and we are looking in blockchain application and blockchain startups the same that we are looking for in other blockchain. And it was basically said here. It's a team. It's why you do it. And by the way, there is a blockchain behind. So far, we invested only and we focus only in blockchain infrastructure. And now we want to go to more deeper in blockchain application. We launched an accelerator on blockchain, and we are looking for application and use cases for blockchain in, I would say, the old world. Is it healthcare? Is it in industry outside fintech? Oh well, obviously we like fintech, but we would like to see blockchain applications outside fintech when there is a use for blockchain. But again, when we invest and when we look on the startups, it's about the quality of the team, and the technology is just the second thing.
Vanessa, if I may ask you what your point of view is on this?
To add to what Dominic, Marguerite, and Peter said, I totally agree that the team in the early stages is the critical component. We only invest in blockchain, and I would even go a further step. We only invest in public blockchain infrastructure or applications. So anything related to private blockchains is not going to be something that is our focus, because it's more like enterprise and increasing efficiency. internally, and we really want to focus on the public blockchain. So on the public blockchain, we also look at sort of the ecosystem of each L1s, and that's going to be kind of a determining factor to assess kind of applications and whether there's enough there for them to succeed. We see the Solana ecosystem that got really hit by FTX. We look at NEAR, we look at all these L1s, and trying to figure out if that first step is something we're comfortable with in order to look deeper into applications that are being built there. Then there's two themes. The first one is developer to developer applications, dev tools, and more audience that is related to developer. And now with the NFTs, we see more consumer product market fit and applications that are useful for the general consumers. So we look at the TAM, we look at the opportunity, we look at the growth rates of each of these sectors, and see if, in the long term, that is a thesis that we think can be true. Of course, we can make mistakes, and that's how we think of it when we look at some projects.
And finally, Frank, what is your word of wisdom on this?
Yes, so we're fully focused on blockchain. We invest in Series B mainly and onwards. And so what we are looking for in the Series B is basically the potentials on the geographical expansion, which seems obvious in the blockchain sector, but actually, even if those projects are natively global, at some point there is a lot of work to be done in this geographical expansion, and that's where we look at the value that we can bring as investors and former entrepreneurs into the company. So in terms of setup, in terms of commercial development, in terms of the next fundraising, etc. So we also look at the potential that we have to help on that global expansion. And basically, like the others, we're also looking at what the blockchain is adding as a value on the sectors that where those investors are applying actually the technology. And as we are serial entrepreneurs vehicle, we invest in experienced teams, or in teams that have already some exit, etc., and experience. And notably, when we look at what has been, the recent news on FTX and others, I think beyond the team, we look at the behaviors of those teams. So that's the how I would sum up the criteria for that we are looking for.
Okay, thanks a lot. And then my next question, I'm going to start with Pierre, because he already alluded to it. Because I work in a financial working group in INADBA, there is an impression that everything that is blockchain related is actually focusing on the financial industry. But Peter, you alluded to this. Where do you see the blockchain projects emerging? In which sector outside of the financial industry?
The sky is the limit. It's so much difficult. I am the older generation. I remember when I was the first time plugged into internet, and if you ask me at the time, I realized that it's a huge thing. But if I was able to say that I will have the internet, I will be connected with my mobile at the time, I didn't know. So we still don't know where the blockchain can lead. But as I said, we are looking for uses outside of what we have seen so far. Because first was the wallet, wallets, then NFTs. what's next? I see huge use in healthcare. I see huge use in industry, in the industrial processes, and so the opportunities are there. There are many things that are can be solved with blockchain, can be solved with other technology as well. But blockchain is kind of easier, is more trustworthy, and especially in developing countries, developing world like Africa, Southeast Asia, there will be use of blockchain in many applications where we don't even think about it, like building electrical grid on blockchain. It is feasible, it is possible, and it's been done somewhere.
Okay, Vanessa, you also alluded to that question in your previous answer. What do you see?
So, the blockchain really allows for transfer of value. Started with the initial Bitcoin and then Ethereum that allows you to create applications. So in essence, financial services is a natural fit for blockchain applications. But I would say that the recent, financial crisis and scandals around FTX show that this was just, trading these assets, not really blockchain applications. So you really have to distinguish sort of the tech crypto and the money crypto, and do not conflate both. The tech crypto allows you to create decentralized finance primitives that are usually over collateralized and I'm not going to say pretty safe, but have different risk parameters than what we've seen in the trading crypto or the money crypto infrastructure, which is more attuned to the traditional financial services and where leverage and risk come into play. So I would say on the tech crypto, if I may, so we have all the DeFi primitives, and that's going to continue to be built because of the composability of the space and being able to put together all these applications and primitives. There's a lot of derivative projects that are being built right now, some of which are still clunky. There's a lot of, so that's the payments and sort of the financial side of things. I think anything related to track and trace and traceability and ESG could be interesting. I think it's still very early in that space and very, difficult for people to focus and incentivize people to participate in those projects. I think the NFT is a really great product market fit. And I think right now NFTs are just, art and PFPs and music and fashion, but in the future, they will represent a lot of different assets. Any non-fungible assets can be represented by an NFT and then traded by an NFT. So the way I see blockchain is really powering finance, commerce, and an exchange of value in any form.
Dominique, any input?
Yeah, so I think in the larger context of Web3, there are certain business models. It's not from we are at Web2 and we will be at Web3 from today to tomorrow. So there are a lot of continuous improvement along that way, and there will be business models enabled by blockchain for any industry. And in general, blockchain makes sense wherever I have to prove something to an external party, right? If I use blockchain only within my enterprise, for example, it does not make sense. But in the example of Vanessa, where I have a lot of industries intertwining, for example, in supply chain, we have one portfolio company which is focused on supply chain traceability and transparency. And especially in Germany, for example, or in Europe, there's a supply chain act coming. You have to show more transparency from a regulatory point of view. Every company above 3,000 employees starting next January will have to show this transparency. There's new regulation on battery passports. So where do resources come from? And this trust layer, which blockchain as a neutral party is offering, is a perfect example. And how will it be used and monetized? It's a simple SaaS solution where a startup is just enabling that function very easily, and in the background it is supported by an immutable ledger. Another example would be within our portfolio, inspired by NFT technology, is for startups. Like, how do you tokenize virtual share options? How do you incentivize talent? How do you work with a more remote and international talent base? And this is a huge problem in Europe, where VSOPs are structured very old school, and they're tokenizing these virtual share options is a great opportunity. Another portfolio company is focusing on communication layer and security layer for IoT devices. Like, how do machines communicate? They're focusing especially on the robotics market. And there are so many examples, like data monetization, data exchange with kind of zero knowledge proof functions. So how do I use data without actually sharing that data? And what Vanessa mentioned also from the NFT side, if they really have value, this will be the next frontier of social engagement. We know videos, we know pictures, but an inflection point really will be once I'm interacting with my follower base, be it a company or a individual, interacting with the follower base through NFTs, and metaverse is only another huge potential if we think about future of work. Just to name a few.
Okay, and Frank, what's your catch on that one?
Yeah, so we do invest in financial services as it is the most obvious use case of the blockchain technology. We also, but we have three verticals. So this one, second one is on infrastructure. So we basically believe that there are so much things to be done, from mining to interface, wallet, and things like this. So many layers to be developed to first, and it has been said before, by attracting actually the community of developers. So that could be Web2 developer that would be at some point interested to develop Web3 with simple tools and framework or library of framework, whatever. So we do look at these verticals as infrastructure to ease actually the transition to Web3 for the industry. And also our verticals where we have heavily invested in entertainment in general, which means gaming, metaverse, NFTs, and so on, because as all the other cycles that we've seen in technology, the massive adoption is definitely coming from entertainment. So we're looking at the new things after gaming, like gaming actually, and the which is, as you know, a 300 billion industry, is moving to step by step into a metaverse, but that the blockchain actually, and that the technology that has unleashed this potential. So this is where we're looking, and in entertainment we include a recent investment we've done in hospitality, where the booking capacity will be transformed into NFTs to allow people to open a kind of secondary market for nights in hotels and room in hotels, basically.
Interesting.
So,
Marguerite, you have anything to add?
I think a lot has been covered already, but I think the way we see the blockchain is not like as a set of industries, but basically we think the blockchain is just going to affect all of the industries. So the question is like how rapidly each industry will be affected. And so how and when should we invest in a specific industry? So I think a lot has been done already when it comes to the Ledger Cathay Fund and our investment thesis. We technically look at all things Web3. So in that sense, we are a bit agnostic. But then there are sectors that we can be more bullish on than others. So gaming, for instance, Frank, you just mentioned it. We're obviously very bullish on that. We would most likely look more at infrastructure play within the gaming industry, just because this is something we understand a bit better, like pure gaming studios, etc. We wouldn't necessarily be in a position to correctly assess what makes one gaming studio better than another one. So if we were to do that, we would need to tag along other investors and their due diligence, like other investors that are expert in gaming and their due diligence. Out of the investments that we've already done, we've invested in obviously like finance related tools. So for instance, DeFi wallets, automated market makers, but you have also different aspects that can be very interesting. For the NFT space, at Ledger, we're very vocal about like various opportunities in NFTs, and we have internal NFT initiatives. So this is something we understand really well. There's also the aspect on governance and the DAOs infrastructure and how you can facilitate the creation of DAOs to create those new governance models that we are very, very bullish on. Yeah, and then basically tools that help Web2 people and businesses transition into Web3. So this is also a space we're looking at, which is not directly finance.
Okay, and as you were the last one to talk, I'm going to start with you for the next one. Because as we can see, the blockchain technology can impact a lot of industries. Is it also a possibility to increase your level of side objectives other than financial objectives? So when I say that, I have in mind something called SFDR, which impacts nowadays the usage in Europe, that imposes traders to just take into consideration ESG objectives into their investment decisions. Is the blockchain technology something that allows you to just go outside of plain financial and move and promote some other objectives? And what would these objectives be?
So I think generally speaking, if we're all here, like from an investor perspective, and if we invest in Web3, it's much more than for the financial outcome. And we've seen that, you know, it can be still a volatile market and it's still very immature, and it's like there is a considerable level of risk associated to it. But it's because we genuinely believe in the benefits of Web3, in the benefits of decentralization, and in the benefits of transparency and like going into this economy of ownership. So I think this is really it's almost more of a philosophical statement that we're doing by investing in Web3 and supporting that industry, more than a pure financial statement. And then for your point on ESG, I think the blockchain can be very helpful thanks to the transparency element. I think in terms of like, it's still an industry that is male driven, and there were also some questions on the consumption. So now we're seeing how the technology improves, and with the merge that was incredibly successful, we're going in the right direction, but I don't think that would be the primary point. But then it's how can you invest in companies that rely on this transparency element and that therefore allow you to track, for instance, I don't know, the carbon footprint of this activity, because you can now track it along the supply chain thanks to the transparency element. So it's just more how you leverage the blockchain technology for mission-driven activities, I would say.
Okay, Vanessa, do you have any opinion on this?
So as a fund manager, my fiduciary duty, or at least what I think my role is really to provide exceptional returns to my LPs. And so for me, that's the focus as a fund manager. We don't have a specific, thesis around ESG, or we're taking that into account into our investment process. I would say that maybe do no harm is maybe the approach here. So you can think of it like when you're assessing projects that are, building on Bitcoin, is that something that you want to support? And but I would look at more from, is that an ecosystem that is going to thrive in the future and where I'm going to get returns? So that's our position here.
Frank?
Yeah, I think on top of the return that we give back to the LPs, I think the Web3 is a kind of spirit of, like we call it in French, the cooperative, which means at some point that the distribution of the money is much more involving the creators' economy. That's true, notably in the metaverse space, but that's true in general. So the benefit of the company will be at some point redistributed into different participants to the industry or to the ecosystem. That's the decentralized piece of it, and I think it is much more sustainable than just centralization of all the benefits. So if you look at what Meta is doing with Mark Zuckerberg, centralizing everything on his metaverse, and what Sandbox is doing, then you better understand where the value is and where people will get some value from their work and the hours that they spend to co-build things in a collaborative mode. Few words about the mining. We have invested in green mining activity, the first industry that could really monitor in real time the type of the consumption of electricity and energy that they are using. And so we have invested in a company in Canada called Sato, where they use wasted energy in a hydraulic power station in Canada, which means that the energy is 100% renewable. It should have been wasted at some point, and then they create value that you can use at some point and transfer to recreate other energy. That could be potentially the business model of the green transition that we are looking for. So I would not. I mean that could be something at some point with ESG impact.
Okay, Dominique, what's your view on this?
Yeah, I mean, a lot has been said. Of course, we are passionate about venture and supporting innovation, but yeah, it's true. First and foremost, VCs should understand themselves as financial products, which is the duty to the LPs. And of course, there are different types of VCs. Some which have a more regulatory focus on ESG or impact, and depending on the thesis, this is what the investors will get. And so we have an ESG policy ourselves, but it's not something at the moment, at least by law, but where we think, okay, it makes sense to not enforce it, but try to make startups aware of this topic, because it's the right thing to do, right? Anything on gambling, child labor, or like all these topics which you should avoid. That is generally a good thing, and a risk management topic also when you invest in a startup. So we, as part of our due diligence process, we push startups to think about this and to establish an ESG policy on their own at some point, but also make them understand that a lot of investors in follow-on rounds, they have these rules. They have to really adhere to ESG policies. So if they don't figure out how to cope with this very early on, then they will exclude a certain investor base. And these investors in due diligence, they at some point at Series B might want to see that you have been working with this policy already for longer than a year. So thinking about how to slowly increase this makes definitely sense. But at the same time, you don't want to overwhelm pre-seed and seed stage startups, because it just doesn't make sense to have a huge policy on ESG for pre-seed startups. But on the blockchain side, of course, there are automatic impact and sustainability topics which you capture with your portfolio. So think about the topic of remittances, or we've been talking about the Ukraine situation where bank accounts are not accessible so much anymore, but still protocols, they're paying some of their freelance developers in crypto, and this is a huge opportunity for them and for developers working remotely anywhere, not having access maybe to their bank account, to still get paid directly with crypto. And we've mentioned several other possibilities like supply chain and transparency and other climate positive applications. So yes, there's a lot of possibility which is inherently embedded in the topic Web3 and blockchain.
Peter?
Yeah, I'm afraid everything was said here. We are not an ESG focused investor. You know, we don't have that as a first focus. Though we are looking for game changers, for startups that will have huge impact on the society, on the entire planet. And that said, you know, you cannot avoid ESG. So you have to have an ESG mindset. You have to be impactful, but it's somehow naturally. You know, it's we are not an ESG fund focused fund. If blockchain can help, yeah, blockchain can provide tools that can help, but it's not the goal of blockchain.
Okay. Now, in the INADBA, we talk a lot about regulations, as you probably all know, and regulation is evolving, as we've seen this morning. What do you think about the regulation itself? Do you think that when regulation is lagging behind, self-regulation can be an answer to that type of issues? Do you think it limits the innovation? Is it a showstopper for investment considerations, or not at all? And I'm not only talking about the financial sector for that question. Who wants to start?
I can start. I think self-regulation would be great, but I don't think we are ready for self-regulation. There's a lot of, very different types of projects, and it's globally distributed. So it's going to be very hard to coordinate self-regulation at this stage. And there are a few associations that are trying, but they're very focused on specific topics. And I think, I would think about blockchain technology as open source technology, and think about, the internet and what does it mean for the future. So this is the type of regulation that you have to think about. The US came in, when the internet came out, with some very specific framework. We haven't seen that here for blockchain because all the attention has been on the financial side and AML and the possibility to offer securities to individuals, etc. And so there are different aspects of the regulation which need to be coordinated. But I think, a close dialogue with the regulator is necessary. I think we haven't seen that. We've seen more some top-down approach from the regulators. So I would love to see more dialogue and less fear on both sides about what can be done here and what's the ideal framework to, maintain a healthy level of innovation and not squash innovation, but also protect retail and financial stability. I think in some instances, the regulator has not acted quickly enough. I think probably in the US, and maybe has focused on items which were of less importance than what was, the elephant in the room in front of them. So that's also an issue. And so being able to understand the potential risks and where you need to deploy some regulation or some guidelines is key also.
Frank, you might have also another perspective than Upchain.
Yeah, regulation is key for the scale of the ecosystem, for the scale of those new businesses. I'm just saying that the requirement is really to have a sophisticated regulator. And this, there is a room for association, there is a room for organization to really help educate, to make it really understandable. And I think the how the technology is sophisticated and could finally be declined in sophisticated regulation. So for me, the match that we sometimes have, like the mistake around the unhosted wallet, for instance, is not pushing in the right direction in MiCA. I'm talking about MiCA now. It's not pushing the boundaries of innovation. It's on the opposite, going in a direction that is not going to be easy, I would say, for the scale of some project.
Dominique, you want to pitch in?
So for sure, I think uncertainty is worse than regulation, and regulation is an absolute must for this ecosystem to thrive. But the right pro-innovative regulation, and I think the point of the right regulator who understands it and who is also open to get into an exchange with the ecosystem is very crucial. So I remember in the beginning in 2017 and 18, we had like these initial policy talks with the OECD. There was a lot going on in Europe where the regulator on a local but also European Commission level, they approached the local ecosystem, and we talked a lot with the regulators. And I think this is a necessary communication which has to happen. And we see examples like with SBF and FTX, how this can ruin the great work a lot of people have done in the industry. And unfortunately, this will set us back a few years now, because the regulators maybe looked at KYC and AML, but not on certain business processes. But however, you have to also understand that this is not a crypto-specific problem. This could have happened in many industries as well, and we've seen that in the past with the cases like Madoff, Enron, and so on. That there are always bad actors in the industry, and it makes it very difficult for the good actors. And I think the good actors who plan to build sustainable business models will not have a problem to work with regulation. And just to give you an example, we have one investment in Nigeria where it's an exchange and remittancy case. And because there's not a lot of regulation there, in order for this startup to participate in a global economy to attract global money, they are pushing for self-regulation themselves. So they approach the regulator. They want to be as compliant as possible. And funnily enough, in a regulated market like in Germany or the US, startups try to find solutions to work around regulation. So self-regulatory works, but you really have to have the right mindset and to believe that being compliant, being at the forefront of this topic actually will help you succeed in the long run.
Marguerite?
Yeah, I think, I agree with everything that was just said, and especially the fact that, good actors will always manage to, be aligned with the regulation. And in the long term, it's definitely what's beneficial. And I think what FTX showed is that basically, if we operate, like if any company operates as a centralized system, then there needs to be heavy regulation to control it, and no regulation is okay for decentralized system like DeFi. But generally speaking, the more regulation is adapted to the market, the more healthy it's going to be for the market.
Peter, you're the last one on this one.
Yeah, well, again, everything was said. But
okay, next question.
Most fintech company always tell me that better regulation is better than no regulation, and somehow it's true because no regulation brings lots of uncertainty, and that means that the big investors, big users, big corporates are not joining the game. So everybody here is waiting for kind of regulation to be able to get to start being involved, because most of LPs, most of the big corporates are so much afraid that they basically forbid their companies to be involved. So. First, regulation will, and I'm mostly talking about financial services. Obviously, the other don't have to be that much regulated. But here, we really need to regulation. We really need to understand what's against the law and what's compliant.
Okay, I'm going to give you my point of view because I've been in banking industry for so long. I think that we are at the point where we've built a set of regulations that, by and large, didn't work that badly for decades. But we are, with the new technology coming in, we're at a point where we seriously need to sit down, take a look at what still makes sense, what still doesn't. And I'm not talking about the main principles that we have behind the regulations, but the mere application of it and the detailed limits that you put into the regulations. Because if you go forward, I think that we have an opportunity to just reduce the cost, reduce the friction that you have in this whole ecosystem because of the technology that is put forward. That's my little catch on it. So the last question. And Dominique, I'm going to start with you because you suggested that one. As an investor, do you think that the blockchain technology is something that you can benefit from in your own business as an investor?
Did I really suggest that one?
Yes, you did.
Maybe it was more the question on clarifying it, but yeah, I think there have been a lot of discussion on how to think about our industry ourselves. It was a development from pure play VC to getting into a more data-driven mode. And now what is quite interesting, and I don't have the full answer, but I've been testing the kind of the DAO model for VC. And within a network I'm a part of called Kaufman Fellows, there has been an initiative called VC3 DAO, and it's around 150 VCs working together. And kind of it started as a how can we work together on a deal flow, deal selection, kind of using the knowledge of many investors around the table who have some sort of sector expertise. And it's been going now for half a year maybe, and it's actually working quite well. And it's I believe it's integratable in any normal venture process, and it just elevates the selection on really focusing on good projects, being able to raise from a founder's perspective a lot of VCs around the table who bring certain value. So and we've seen this in traditional frontier tech investors as well, that they're starting to test out the more DAO approach. So I'm very excited to see where this will go. I've experienced first initial positive effects of this. And I think DAOs can have a great impact for many businesses. and different models.
Yeah, I must strongly agree here because I see big future of DAOs, tokenization of all assets, democratization of VC investing and so on, and the blockchain tool will very, very much help. Investors most of the investors are very conservative, so it will take time. So we know more or less how to do it, but again, it's investors and they're being conservative and the regulation again. And once this is over, I'm so sure that the future of investing will be through DAOs and similar tools.
And Frank, what's your point of view on this?
Yeah, we've been very inspired by the technology and by the decentralization of it when we did the setup of True Global Ventures 4+, which is the fund dedicated to blockchain. We've been trying to get 30 founding partners across the globe, from San Francisco to Singapore, in 20 cities. Actually, we are putting at stake our own money, so it's quite unique. We have 30 to 40% of the fund which is owned by the GPs. So we have a specific investment committee as well, according to the verticals and where we deliver expertise. We share the deal flow. So we're not what we call a DAO, but not that far, I would say, in our setup, which is quite unique and shows strong commitment in terms of deployment strategy. And that's, I think, a value proposition on the VC market that is quite unique. And secondly, yeah, for sure, there is a lot of VC funds that are going to be tokenized at some point. As you know, VC is an illiquid asset class, and so looking at the lifetime value of investment, etc. At some point, we should get for ourselves what the benefit of the technology in tokenizing partially or completely the fund. KKR is doing this. There are a lot of things coming on that part.
Okay, thanks a lot. On this note, I'd like to open up the floor.
Just one more comment, actually. If you look at Syndicate, which is a company based in the US, which basically facilitates the creation of DAOs, the first use case that they had was on investment clubs. And so basically anyone up to 99 people could gather together and create their own DAOs. And then you would have the right legal template and governance rules in place to make investments based on decentralized decision-making that you have defined for your DAO. And Bessemer actually already put in place, used it to create their own investment club for business angel investing. So it's just, if anyone in the audience is interested in learning more, you can check out syndicate.io. And investment clubs are their first use case. So it's a good illustration to what Frank just said, I thought.
Okay, thanks a lot for that. Michael, I see that you have an interesting question around teams and how teams are measured, quote unquote. Do you want to step in and ask the question?
Yeah, hello, can you hear me?
Yeah.
Actually, it was quite a general question, but I saw that it is important for our participants here today that they want to measure how good the teams are before they actually invest. That's why if we have time to discuss it, we may do it. But perhaps more technology-related questions are important here. I don't know.
Let's start with you, and then I'll go down the list and see if we have more questions. So how do you guys take a look at the team and measure its quality, complementarity?
Maybe just where it comes from. So working with startups, especially from pre-seed to Series A, you see that there is you have an initial team, the team will be extended. It is a very challenging time where you're scaling, you're bringing on new talent, there's a lot of trust involved, and most of the time you're even pivoting your business model on the go. So what we are trying to figure out is like, what is the capabilities of that founder, and where can we see proof points of that founder? And how do we do this? Is by reference calls. Like we call former employers, people you worked with, try to gather opinions of to get a well-shaped picture as far as we can. I mean, you don't kind of marry someone just knowing them 1 or 2 days, and you're spending basically, the average exit is maybe after 7 years. So you're spending a lot of time together. So you better make sure that you're working with the right people. And I've worked with uncoachable founders before, and it's very difficult because the VCs are not your enemy. Once they are invested, they're actually on the same team, right? We only want to support and help. And unfortunately, I've experienced founders who don't understand that concept. And so through all those learnings, we try to see on the capability side, what are the next fundable milestones which have to be achieved? So is it certain traction on customers? Is it certain development on the product? Is the team complete? So we've declined deals where it's a very technical topic, and we've seen that there are only business founders and no technical founder in place. And the other way around, we've seen where there are just technical founders in place and they have no business acumen. Team completeness, capabilities of every individual, how do they interact each other? We purposely sometimes interview teams individually and in a team setting. We do sometimes 1 or 2 day workshops with the team together to figure out how they tackle certain questions and problems. And we run through certain case studies and situations. How do they think about, are they sensible in how they think about a certain thing? So I saw another question on valuation, for example. Valuation is just a small part of the entire game, right? Valuation in context of how quickly will they achieve kind of break even? Will they have to raise another round? How do they think about this? How do they understand terms within a legal document? Do they know that liquidation preference and certain terms in a shareholder agreement have very severe consequences, and that valuation actually is not the only measure to look at? Right? All these topics and getting answers and discussing these on a very open manner with founders will give you a very good picture on how this person thinks, and what you might expect when working together. So it's getting to know each other as good as possible.
Anybody else wants to pitch in?
I think one of the traits that we look for, first and foremost, is integrity. I think having that as the base layer, I think it sounds obvious here, but it's not, as we've seen in the market. I think I want to see like high energy, grit, people that will be able to push forward the project, because basically when you're a founder in an early stage company, and especially in blockchain, you kind of have to will things into existence. And so having that capacity to do that, having the capacity also to lead the team and be an inspiring figure, I think is really important for us. So this is more about like the founder, the CEO, the team of founders. And then we want to see, either prior experience where they have demonstrated that, or specific conversation where we think that could be the case.
Okay, I see that our time is up. So I thank you all for participating, either as panelists or just attending the panel. This type of discussions is maybe not on the investment side, but on the consequences that you can have on the investment side is the type of topics that we talk about in the working group in finance. So if you want to join these type of meetings, feel free. We are there twice or 3 times a week, dependent on the topic. And on this note, Bara, I give you the floor back.
Thank you, JC, and thank you to all the speakers and the panelists. Thank you for the wonderful discussion. I would just like to invite you for our last panel today, which starts at 5 o'clock, and it will look at the future of digital identity. It will be preceded by a short meet and greet with some of our board members and the executive director. And we would very much like to welcome you to that as well. So thank you so much and have a nice rest of the day.
Thank you
very much.
Bye.
Thank you. Bye.
Thank you.
Bye.